We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Michael Becker.
Doing well. How are you?
Awesome. We're doing wonderful. It's a hot summer day here in, I think I always try to tell people, middle America. Here in Kentucky, it's humid and hot, and we actually are needing some rain as we speak. Our grass is usually greener, I guess, than it is in most of the places I do podcast interviews, and it all looks the same right now. So anyway, but why don't you start out, kind of give us a little backstory about yourself, and I just realized there behind you, SPI stands for Strategic Property Investment, right?
That's right. Yeah.
Okay, cool. All right, so we obviously can cover an array of topics here because it seems like just in the title alone of your business, I can pick 4 or 5 different angles here. So why don't you tell us a little bit about yourself and how you got started in real estate, and then we'll kind of go from there.
Sure. Yeah. Michael Becker. I'm based in Dallas, Texas, co-principal of a company called SPI Advisory. So we'll run the Dallas office. My partner, Sean, is based in Austin. So he kind of runs the Austin office. And so we own multifamily in Texas, Dallas, Fort Worth, Austin, San Antonio, the markets we focus on. Bought our first multifamily property in 2013. We purchased 14,000 units in that time period. We've been selling quite a few things here lately. So I think we're somewhere between 6,000 and 7,000 units right now. We're actually buying a 340 unit deal next week. So we'll pick a couple more units up. But prior to getting into the multifamily ownership game, I was a longtime commercial real estate lender. So that's kind of how I figured out this business. I was kind of loaning money to other people and kind of realized I was on the wrong side of all those transactions. So I started out probably like a lot of people, I think it was 2011. So 11 years ago, bought my first investment piece of real estate, which was a 3-bed, 2-bath house in Mesquite, Texas. I think I paid about 75 grand for it, maybe put, 10 or 12,000 in it and rented it out for $1,100 a month, and did 16 rent houses, and then realized I wasn't very scalable, and kind of reflected back to what I did all day, every day at work, which was making loans on a lot of the broken kind of multifamily deals coming out of the Great Recession. I was doing a lot of lending, kind of bridge product, kind of putting Humpty Dumpty back together again a little bit, and it's been a hell of a good run. It's been kind of the golden age of multifamily ownership that we've been living through, at least in my time period.
Yeah. And it seems like every time we have this discussion and I start talking with people, where do you see multifamily going? It always, and it's taken a little bit of a mindset shift for some people to realize that some of these cap rates are as they've gotten lower and lower and lower. And even somebody talks about a real estate agent showing them something that's got a pro forma cap rate of 6%. In reality, what are we talking about? And, not that they're lying or anything, but just that maybe they're, I guess, fluffing or making things seem like they're considerably better than they are. But where do you see this trend of multifamily going? Obviously, we've got rising interest rates, which has changed the landscape quite a bit. Just here, as this is being recorded, just in the last 2 weeks, we've seen a massive shift in the real estate markets just in general. But where do you specifically see multifamily going as we kind of move through these times?
Yeah, a little historical perspective.
Obviously, you're buying, right?
Yeah. Historical perspective before we get in that. I bought my first deal in 2013 in Dallas, Fort Worth. You could buy a brand new Class A deal for about a 5 cap. A Class B deal, kind of like 1980s deal, would be like 6 to 6.5 cap, and a C class deal, it would be somewhere around 8 to 8.5. And kind of fast forward to today, everything's pretty much on top of each other. At least it has been here up until recently. Where everything was kind of plus minus a 4% cap rate, regardless of location or quality or age. And that didn't make a lot of sense to me. So we kind of took the opportunity when we first started buying deals. We bought a lot of 60s, 70s vintage, and then bought some 80s stuff. And now kind of what we own is generally class A to A minus. So think 20 years or younger, year 2000 newer. That's generally what we have. The deal we're buying here in a couple of weeks is a 2016 vintage deal in downtown Dallas. So kind of a true class A deal. And that because there should be a delta between the cap rate you pay for something that's new and newer built, better vintage, higher demographics from an income standpoint, et cetera, versus something that's kind of older and maybe in the hood or something like that. So the
Yes.
market got ahead of itself, I think, a little bit, and didn't quite price in the risk. So we took that opportunity. So as your question is, where does it go from now? We're seeing a lot of conflicting information from, it's kind of like, think of the Charles Dickens book, Tale of Two Cities. It's the best of times, it's the worst of times, right? So the good things are, we have never, to my knowledge, seen rental rate growth like anywhere close to what we're seeing like in the real time, going back, say maybe 2 years, kind of, the rental rate growth has just been staggering. Maybe last, say 15, 18 months. The rental rate growth has been staggering. Historically speaking, if we get 3 to 4% rental rate growth, I'm ecstatic. A lot of the deals we're seeing now, they're all basically in the double digit rental rate growth. So you're seeing things, with 15%, 20% new lease trade outs over old leases, and you're seeing renewals in the 10 to 13%. So, you're 4 to 5 to 6 times historical norms and rental rate growth. That's unbelievable. Occupancies are all time high. This is from the perspective of a guy that owns properties in Texas, but I think that's generally true of at least the Sun Belt, from Arizona to Florida, the Carolinas, and kind of in between. That's where a lot of the migration is coming from, the coastal markets and some of the Rust Belt markets into the Sun Belt. So you're seeing tremendous rental rate growth. But then you couple that with interest rates rising and the capital markets getting really difficult. Really, I would say since about January, February of 2022, you started seeing kind of the shift around February, and then kind of March, April, it started getting quite a bit harder to where we kind of sit today, and kind of the summer of 2022. You're seeing interest rates have gone up dramatically. The Fed's saber rattling. They're going to continue to raise rates, try to curb inflation. If you go back to as recent as November of 2021, the Federal Reserve didn't expect to have a single interest rate hike in 2022. And here we are, they're hiking 75 basis points every time you turn around. So it's just the rate of change is just dramatically different expectations and reality versus less than 12 months ago. So that's what's causing dislocation. It's causing lenders to lower their loan to values because the deals aren't sizing as well. So you're starting to see some pricing softening. So I would say, what my observation and deals we're seeing probably 8 to 10% price adjustment on a kind of class A deals from the peak. And then probably the workforce housing, your 15 to 20% price adjustment from the peak. But to put that in perspective, we had such an artificial run up, I think, towards the end of 2021 into the very first part of 2022. There's just so much deals that we're trading that really at artificially low cap rates, because everyone's betting on this rental rate growth, that you're seeing things trade in the 3 caps, which just doesn't make much sense.
And that was one big issue that I've had as of late with this whole run of multifamily. I guess is really what I would call it. The run of multifamily, I feel like, has somewhat been fueled by, because, all right, for instance, there's a complex here in town, and I always go to what I see locally, because I know if I see something, it's generally probably happening more than just what I see. So I go to exactly what I see. There's a complex here in town. I think it was like 75 units, and rents were like the top rent in the whole place, 2-bed, 2-bath building, fairly new. I'm talking about units built within the last 5 years, right? And I think the top rent was like $900. And these guys put it on the market, and they actively pursued basically the best offer that they could get. And they got a really good offer for it. And then the guys that bought it, their business model was to turn right around almost immediately, like the day they closed, and they went up on the rents, say, I'm going to say 30%. So like they went, so the top rent goes from $900 to, and they had a stair step plan, so it's not really fair to say they went directly up. But like the if you weren't on a lease any longer, your rent went to 1,200. If you signed a lease, it went to 1,100, and and somewhere in between that type of a setup. And I stepped back and I really got to looking at what the industry as a whole was doing, and a lot of these deals were being underwritten, LOI'd, underwritten, purchased, brought investors in, and the bulk of what their business plan was to go up on rents. Okay, now I say that because that's a great plan if it holds, but it's almost like people owning vacation homes. People, when things get unaffordable, they tend to come back down. And I guess I'm just wondering, at what point will the vacancy rates on the other side catch back up with the steepness of the curve of the rent increase, I guess.
Yeah. So it's complicated, but I think my general view is that we read all these headlines, and every area is a little bit different. So I'll kind of speak more to the Sun Belt, because I think that's really kind of your more on market. And if you want to go to like Minneapolis or go to so maybe some dying Rust Belt city, or some of those coastal markets, even like San Jose, San Francisco, have some problems with some of the political stuff they have out there. Probably perform much worse. But say you're generally in a Sunbelt market like Dallas or Phoenix or Atlanta or someplace like that, you're seeing the home pricing have rose dramatically, since this COVID. I mean, you're seeing 20, 30, 40% price increases in a lot of these markets. So made home ownership unaffordable. Now you couple that with rising interest rates, which makes your mortgage payment unaffordable. So it's keeping people in the rental market longer and driving new people that otherwise would be leaving the rental market to buy a home, staying in the rental, going back to the rental market. So it's increasing the amount of demand. And then you're seeing some migration patterns in places like I just mentioned, Texas, Arizona, Florida, et cetera. So you're seeing more and more demand. And now you're seeing with the inflation on the materials and labor and land, lumber, all that stuff, it's harder to build these things. So I think you're going to start seeing some supply get restricted. You're seeing some of the new home builders like have contracts canceled because the buyers can't afford it because they got out of escrow 4 or 5 months ago, and the interest rates have went up 3-4% or 2-3% or whatever. So they're going to stay in there. So they're going to stop building more homes. So I think we're going to continue to see upward pressure on rental rates. I think what will happen will be, if we see massive layoffs, which I think we might be on kind of the front end of this, or in a recession on the front end, of maybe some layoffs. You're starting to see some of the headlines around that. I think that'll have something that can mute some of the rental rate growth. But I think it's going to be really spotty on location. One, I think two, the inflation impacts more people on the lower end of the scale. So I think if you have more of a workforce housing type of demographic, that's going to be a little bit more impacted than if you had something nice, new, and pretty where they can have a little higher income. It's not quite as impactful with food and gas prices, et cetera. So I think it's going to be bifurcated. And I think what I was saying, the risk of the cap rates being on top of each other doesn't make any sense from a historical perspective, from a risk adjusted return perspective. So I think as cap rates, rise generally with rising interest rates, I think they'll rise a little less on the nicer stuff and rise a little faster on the older, kind of tougher stuff, as they should, because there's more risk within it. So I think you'll start seeing maybe more, instead of being on top of each other, maybe more of a 200 basis point or 2% spread, maybe a little bit more between the top of the grade class A and your generic workforce C class deal. I think that's what's going to happen. So I think the values will hold and be stickier on the nicer stuff. That's what I think is going to happen.
Well, I think there's and then there's that. You had a guy tell me one time when we were trading in farmland, which on the sales side, he said, "Man, you can't hardly buy a good farm cheap enough, and you can't hardly pay enough you can't hardly buy a bad farm cheap enough." and you can't hardly pay enough for a good farm. And it's the same thing I think in this stuff. And it's like, man, that new stuff just really pops, and it's like that's where people are kind of migrating to as these things happen. But the problem is the wages haven't kept up with inflation. I mean
Yeah.
that's and I think that's the same problem people
Yeah, you
had in the
say that, but I
80s.
don't think that's necessarily the case on the kind of the middle income Americans have been seeing quite a bit of household savings and through the stimulus stuff that they had. So I know they're starting to burn
Sure.
through that now. We're starting to see credit expand a little bit, but I think the wages really are there. I mean, if you look at the rent to income ratios and what we have, I mean, they're still holding up. So I think maybe part of that is, I'm playing in the three of the four majors in Texas, and we're seeing a lot of people come sell their house or move from California or wherever and come to Texas. So they're having these higher wages, getting transferred, working remote, coming to Texas, and their wage goes a lot further in Texas than it does in California. And then even if the wages don't keep up, I mean, I think people will just kind of reprioritize what they spend money on.
That's
If you
true.
try to rent an
Yeah.
apartment in California, I mean, a lot of these people spend 50% of their income on rent, and they just can't spend as much money on other stuff. So I guess in California in the summertime, you can go sit outside and go to the beach. And Texas is 105, so you got to go sit in your apartment. So you need to go spend money on going to the movies or doing something else in Texas in the summer. But that's kind of, I mean, I think people just will kind of have to accept lower quality of life as inflation hits them, and they have to prioritize food and transportation and housing.
Yeah, yeah, definitely. And again, it's just it, people act like this is a problem right now, but it's always a balance problem. You know what I'm saying? It's always what's too high, what's too low. You got entrepreneurs wanting to get all they can get out of everything, and then but you said you're in three of the four major markets in Texas, which would be what would the four
So
be?
I'm in Dallas, Fort Worth, Austin, and San Antonio. We don't play in Houston. So, yeah.
Houston is a funny market, man. Houston, man, I don't know. It's so weird because it's hard to tell sometimes what assets have been repositioned from like Class C to Class A, and you end up with a Class A asset in a Class F area, and then it's a really weird market. I think. What's your thoughts on the
Yeah,
Houston
that's
market?
right. It doesn't have any zoning. It's the largest American city without any zoning. So, city of Houston proper is weird. It's still pretty oil dependent. So, you got a concentration. So, you would think here in the next couple of years, with oil being above 80, that it should have a hiring boom, which I haven't quite seen yet. So, you think that'd be good. But then, all of a sudden, every so often, they have a giant hurricane come in and hit it. And then you have a couple
So
bad
then you
deals.
have that odd wild card outlier that makes it almost unsystemizable. But the people that love Houston. Like it's just they're not going to do anything anywhere else.
So,
So
we'll let those guys make the money in Houston. I'll make it somewhere else.
I don't blame you. I don't blame you. So you said Dallas, Fort Worth,
So yeah,
San
DFW,
Antonio,
Austin, and San Antonio. Yeah, Dallas Fort Worth functions
DFW,
as one
Austin,
market
San.
generally. Two different sides. They're a little bit different, but generally speaking, it's one giant market.
Man, and I tell you what, you talk about we're in a deal right now in Allen, Texas, that we're
Yeah,
working on raising capital for, and it's a that whole area, that North Dallas is just. I just can't believe that when I was a kid, we would drive through there, and I mean there just wasn't anything. There was nothing in that whole. It wasn't that it was nothing. It just was very open, and now they say it's just inundated with houses and
right. I'm about to be 44 years old, and when I was born, I grew up in Dallas Fort Worth my entire life. I think we had less than 3 million people in the MSA, and we're approaching 8 million people right now in 44
gosh,
years, right?
almost
So I mean,
three times.
and like
God.
Allen was just in the middle of nowhere. I mean, it's the boonies, and now it's all
Frisco,
developed
Texas.
around it.
Frisco, man, we used to buy cattle from Frisco. I mean, a bit like just north of Frisco, and it's
Yeah.
just and it's just and all of that is like a really highly desirable area now. I mean, it's not like it's just still some country bumpkin place where people all of a sudden started wanting to live. I mean, it's pretty highly desirable from what I understand, especially as you get up to the lake and in that area. At
Very much
least
so. Yeah.
that's what I've been told. I've never
Right. And
or I
so
haven't been
so
there.
Dallas is completely transformed from what it was when I was a kid, right? And we had a really tough time here in the late 80s, early 90s with the S&L crisis and a bunch of overbuilding in the 80s with multifamily, which is why there's so much 80s product, 70s, 80s vintage product here. They just got overbuilt for what the
Yeah,
population
and it's the
demand was.
same. It's the same in a lot of the because Dallas is almost as much middle America as say Nashville. It's all the same kind of middle continent kind of places where there was a lot of workforce at one time, and especially around here. And then Nashville is like Dallas; it's gotten a little bit boutiquey now, and now all of that stuff that was 80s, just basically run of the mill workforce kind of stuff. Now it's being redone, and it's like turning into one big boutique, I guess, in a way. So, so with that being said, and all of our problem solving that we've done on here, or at least hopefully help that we're giving people, what are you all in? Like, where are we headed right now for you and for SPI?
Yes.
Um,
So I mean, I think we've taken the opportunity here recently. We've been probably more net sellers than I wanted to be. So we've sold. Let's see, this year alone, we sold 4 deals, or we refinanced one, we recapitalized one. I have two more that we have awarded that I'm about to get in escrow, and hopefully we'll close this year. I'm not counting my money until they actually close, and then
yeah,
we're about to buy our first one for the year, which we're off. I mean, I was going to try to do eight or 10 deals this year, and we're only going to have one
sure.
done. And it's almost at the end of July by the time we close that. So we're going to be woefully short. But with that said, I feel fortunate that we've been active and trying. We just have been unsuccessful because we just couldn't make the math make sense. We were trying to get aggressive. It didn't make any damn sense. So we avoided a lot of these things. So I feel
Yeah.
good about that. And now with the pricing kind of resetting, it feels like the capital markets are kind of starting to stabilize a little bit. I think
Well,
anything
and
you
that's
buy
another
between now
piece
and
of
the end of the year is going to be great.
what I was gonna ask earlier was I had a guy tell me, like, and it may have even been on this podcast, my listeners should probably tell you, but that some of these people at the levels we've been in this year, and you saying you haven't bought one this year shows your experience, for one, because there's been a lot of people that have bought this year that were buying simply for the acquisition fees. They're taking investors' money, they're getting they're putting a whole deal together, and they're going and buying so that they can charge the acquisition fees, even though they know and that their pro forma, or that their stuff isn't, could be questionable, or could really have some real questionable aspects to it. And so, do you feel like that's gone on a lot? And then now we're kind of going to start feeling like that we've got that out of the way. All that's, and then what's
I
going to
don't
happen if
know if
that comes to
it's so
fruition?
much that. I think there's what you've seen is a lot of people that hadn't lived through a cycle, right? So I've only been owning apartments since 2013, but I was a banker for a long time before that. So I was kind of the grim reaper 14 years ago, doing problem loan workout, trying to collect all these bad deals back 13, 14 years ago. So kind of got a lot of experience on someone else's nickel, looking through that. So I think at the end of this, it was like we're just seeing double digit rental rate growth. Every deal that you bought, you can turn around and sell it and make a bajillion dollars on it, and everything you touch turned to gold. So I think it kind of led to more and more people that maybe were passive investors come try to be sponsors and then put these syndicates together. And so I think it would just kind of peak euphoria, and everyone just thinks it's going to keep going up until it doesn't. I mean, shit, you have cryptocurrency stuff that what the hell
Yeah,
is that, right? And that was a multiple
yeah,
trillion-dollar market that's been cut by 2/3 already, and it's probably going to zero because what is that? And the NFTs, people pay millions of dollars for a JPEG of a monkey, right? Like, so you just had a lot of froth out in the market. So obviously we have a real tangible asset that's essential need for people that the fundamentals got a little bit out of whack with these cap rates getting down to 3% because they're paying for the growth in the rental rates. But I think once you kind of reset that price a little bit, it's still going to be good because the demographics are still very strong, in particular if you're buying in the Sun Belt market. So I think it's just a little moment in time, but you just got to reset the pricing a little bit with what the debt is. And I think with this reset price, I said about 10%, give or take, on the Class A. Hell, we're probably back to where we were in like December or January in pricing because it ran up so much in Q1, Q4, and Q1 that we're put in perspective, you're still above where if you bought anything 12 months ago, you're still probably above where you were 12 months ago. If you bought a nice Class A deal, a workforce housing deal, maybe you're back to where you were summer or last year, or maybe Q1 of last year. That's kind of where the pricing is. In the meantime, your rents keep going up. So if you just own it long enough, these rents are going to keep driving your NOI up
Well,
and start catching up for some of the cap rate expansion you're seeing right now.
and I thought a lot about. I had a guy ask just today about what's more beneficial, an open-ended fund or a closed-end fund. And obviously, I said, well, it just kind of depends on obviously what the asset is and what the underlying stuff is. But with that being said, I thought, an open-ended fund, the benefits of that right now is going to far outweigh anytime you have something where you get crammed up into a corner and something has to happen, just doesn't seem like a good fit. But it's more so could potentially happen now. If you buy something now and you're slated to do something within 5 years, and then you get to that 5 year mark and it's like, and you've got 1 year extension built in. So then you hit that, and then, you kind of start getting crammed up there. And if you can't make something roll, then man, it just seems almost irresponsible. Then you have to have a vote to see if you can push it on. I mean, I guess I just see that getting messy in a way if you buy where you're having to push that on out.
That's right. Yeah. So as long as you have time, usually time cures most of your problems in this business.
Yeah,
So as long as you're not so over levered and make a fatal flaw where you can't recover, because a lot of these, like I said, it's been high cotton for a long time, and it was the golden age of multifamily. And if you've been in this business for less than a decade, then you haven't seen really any tough times. So even COVID really wasn't that big a deal. I mean, I thought for sure it was going to be maybe the end of the world is kind of what it felt like in real time.
Sure, yeah.
But it wasn't that big a deal. So this is different than that, and this seems closer to 2008, and which I lived through. But this does not feel like 2008, because 2008 there was no liquidity, and the fundamentals of the housing supply demand were completely out of whack. Where we're undersupplied in housing, we were oversupplied in housing then. So that's materially different. And then there is still liquidity. So it might be at a higher interest rate, it might be a little bit lower leverage. But if you go back to 2009, you try to put a loan out, there was just no liquidity. If you didn't get a Fannie or Freddie loan, there was just literally no liquidity. So it's it's not that, right? And we're in a much better starting employment base, and so I don't think it's going to be 2008. So I think it's going to be dislocation, and it feels painful in the moment, but even go back to like 08, 09, by 2010 we're recovering coming out of that. So
That's right.
if this started 6 months ago, it's going to take a year, maybe 2 years on the outside. If it's 2 years on the outside, we're already a quarter of the way through this, right? It's probably not going to be 2 years. So 6 months from now, we're going to be kind of recovering coming out of this.
And I've oftentimes said that, and I recently just brought it up on this show again, just a couple episodes ago, about how, when somebody is I have nothing in common with a bodybuilder, so please don't take this as like an example that I know about or anything. But I'm thinking, okay, a bodybuilder, right? He's equally doing his body just as much good on his rest days as he is his hard lift days, right? I mean, and to me, everybody hears the word recession and they seize up. They're like, what recession? You mean? And in general, in my thinking, I'm like, okay, everything goes up, then it softens, then it goes along, then it can go up more, and that softening period is it's rock underneath it, I guess is what I'm getting at. That's where everything kind of solidifies and becomes solid, and then you can work up from there. That's at least my thinking, but man, maybe that's too much like storybook. I don't know.
Yeah, no, I mean, I think as long as you set your deal up right on the front end. So if you had a deal that was
exactly right,
had a bridge loan on it at 75, 80%, and then you layered some preferred equity, you get up to 90% behind it, and you got an adjustable rate mortgage on your first, plus you have a big pref payment you got to make. Those deals, and you got to get $300 rent bumps like the deal you're talking about, and market softens a little bit. You might have some problems, but if you went in this thing with 70% leverage and had a bunch of liquidity set by side and are properly escrowing money for your interest rate cap replacement and operating reserves, and running the thing right, you just kind of hunker down a little bit, put your head down, and come out the back end, and you'll be okay.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
Yeah, and I think a lot of times people averaging that pref payment and the interest on the loan that they're getting when you put those two together, I mean, I think that is almost people can't be so scared that they're not going to find investors and screw up on too high of a pref payment. That's I guess my thought process on that is like they're trying to lure investors in by saying, "Hey, we got a pref payment of this," but then that's better than so and so. But then what's the use of having a pref payment that's this if you end up losing money or God forbid something else happens, So anyway, well, listen, Michael, we're getting close to the end of our time, and I want to thank you first of all for being on our show today. I mean, everything's been insightful. We've been really technical, talked about a lot of the ins and outs of this stuff, and I think that the information that we passed along is going to be very helpful to some people, especially some people that are maybe moving into their first deal or people that are thinking about their first deal. But with that, we have a couple of questions that we ask every guest that comes on the show. And the first of those is, what is the best book that you have recently read or are currently reading?
I'm not the biggest reader, so I don't read a ton of books. But one that kind of comes to mind, I liked a buddy of mine, Ken McElroy, wrote a good book. It's ABCs of real estate investing and the advanced real estate investing guide. I think there was two of them. So I thought he runs his company pretty similar to the way we run ours. So I think
Sure.
a lot of our philosophies are aligned. So if you're looking to get into it, that'd be a good book or books to read.
Awesome. Okay. What is a dream vacation that you've either taken or hope to take?
I recently got back from Hawaii, which was nice, but I've done that a few times. And then,
Dude, you and everybody else has been on this show for like the last 2 months. Like, I don't know if y'all had a huddle there or what, because I've had more Hawaii answers lately than I could even count.
Everyone's been getting rich, making buying apartments, so we're going far away. So this Christmas
Time to go to Hawaii.
We're going on a European river cruise over Christmas. Up the Rhine River, going from Basel, Switzerland, and then in Amsterdam, hitting a bunch of the Christmas markets, basically splitting France and Germany. So that's gonna be really cool. I didn't grow up with any money, didn't grow up traveling like that. So glad to take my family to do stuff like that.
Well, that's neat. I've never actually heard of that because I've oftentimes wondered, like every time I've been to Europe, we go to one place, like, or maybe, one place and a surrounding town or two, but in general, one spot. But that's pretty neat if you can travel that and see all of that different culture that goes on between the two.
Yeah, pretty excited about it.
Awesome, man. Awesome. Well, listen, if the listeners heard something that resonated with them and they'd like to maybe get in touch with you or find out more about SPI, what is the best way for them to do that?
I'll give you two resources. So first, I don't mention at the beginning, but I also co-host a podcast. It's called the Old Capital Real Estate Investing Podcast. I've been doing that since 2014, I think, with my partner, Paul Peoples. And so you can find us at or anywhere you probably hear my voice now, just kind of search up Old Capital Real Estate Investing Podcast, or it's oldcapitalpodcast.com. It's all about apartment investing. So if you're an apartment nerd, it's one for you. Or the company I run, as you mentioned, is SPI Advisory. So just go to our website, which is www.SPI Advisory. That's SPI like spy advisory.com. And a bunch of information just updated, our portfolio, contact information, fill out a form. We do quarterly newsletters. So if you want to sign up for the newsletter, kind of get my thoughts of the market 4 times a year, we have a bunch of resources there as well.
Awesome. Cool deal. All right. Everybody heard that, SPIadvisory.com.
Yep. That's right.
And check it out, and also check out the podcast that he mentioned there. And listeners, as always, please head down and leave us a 5-star review and also type a review so that other potential listeners may know what we talk about here on the CashFlowPro. And as always, as well, please hit that subscribe button so that you can be notified when we release new episodes. Michael, I want to thank you again for being on the show today. And listeners, I hope everybody has a wonderful rest of the day.
CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.